Hey Shane, how's it going?
COVID Kyle, what's happening, man?
Not too much, just trying to recover and I apologize for my voice, but I'm on round two over here, but lasted 18 months in between, so you know,
Yeah, I was telling you guys, I haven't had a single illness of any kind, like not a cold or a stomach bug or nothing since I had COVID in April of 2021. So I'm I'm due for a cold, but I'm on a good run here and very happy about it. So
good to hear.
sorry for you. I'm glad you're feeling okay though, and making progress towards recovering.
Yep. So, and for everyone watching, today's August 18th, and I don't know if maybe it's just the COVID brain or what, but I'm looking at the market and I'm a little confused here. Sitting up at resistance, but I don't know which way to call it long term at this point. So, Shane, hopefully you have some good perspective, but why don't we go ahead and just turn it over to the SPY chart and start
Yeah.
there?
Sounds good. Well, don't forget, my perspective is almost always wrong. My win rate this year is like 35%. So, with a healthy dose of human nature, again, man, I don't know. I've talked about it before. I'll probably talk about it some more, but in order to be good at this, you got to be able to bet against yourself. I mean, you got to be able to look at the market and see it with nothing but, bad news and nothing but, bearishness, but you still got to be able to go put money to work. I mean, we manage money for people who, who are good. They're going to use this money to retire. They're going to use it to send their kids to college. They're going to use it to buy a new vacation home, or it's serious money. It's not to be bet, like you're in Vegas gambling, or it's just not like that. So, um, we have to take what we do pretty seriously, and when the market goes against what we think is happening, we have to be able to invest counter to what we might personally think and believe, and kind of want to see happen. So, as bearish as I've been, and as much as I want to see the market go lower, we've been buying stocks since the end of June. Um, we, just looking at this chart, we went 50% cash or more in April, and we didn't buy our first stock until from that point, we didn't buy our first stock until June 23rd, I think it was, which is like 2 days after the low on June 21st. And so it's no surprise, that the market dropped that entire time. But also, like when we got to those lows in June, I mean, there were so many stocks that were trading at, I shouldn't say so many, there were at least a few stocks that were trading at reasonable valuations for the first time in years. And if you put the right stop in place from those lows, like the chances of you stopping, like not saying stocks couldn't have gone lower from there. I thought they would and probably deserved to. But, if you buy something that's already down 30 or 40% and you use a 20% stop loss from there, the odds that you're going to get stopped out of that position are very small in the short term. And, if you do that enough times, you'll get lucky and you'll pick a few right at the bottom. And, that's how it works in this game. And I think the best portfolio managers are able to hold, competing thoughts in their minds at the same time and then act accordingly, never being all cash or all in or all long, or um, what's the t-shirt, irresponsibly long. That we don't get irresponsibly long, we don't get irresponsibly short. We never get into investments that we don't know how to get out of, and that includes cash as an asset class. We know how to get out of cash. In hindsight, maybe we should have put more to work, because we still have a pretty healthy amount of cash, but it's nowhere near 50% anymore. Um, so yeah. Anyway, we'll see what happens from here, but market has definitely rallied. What are we up off the lows now? Is it like 15%? A little
It,
more probably.
yeah, it should be right around there. Last I checked it was 14, but
Yeah. What do I got? I got yes, 17. So
mhm.
17% rally, 16.9 depending on how you draw the line. Um, so still not quite a 20% rally, and as we can see here, markets run into that light blue line, which is a 200-day moving average, and started to pull back a little bit. Um, so uh, I'm not surprised that the biggest index in the world is reacting to the most important moving average on its chart. There's no surprise there. How far does it drop from here? Can we go all the way back to the 50-day? Can we go all the way back to the lows? Sure, why not? The economy isn't really in in great shape. I don't care, who you are or who you ask. You ask the Fed, they'll say, "Oh, the economy's great. We've added all these jobs." Somebody's always got a reason to be bullish or bearish. So I personally don't think the economy is in a very good spot. Income inequality is a real big issue for people who can afford food prices where they are and home prices where they are. That's great, but there's a lot of people out there that can't and that are really struggling and suffering, and I feel bad for them. So I don't think the economy is in a great spot, but that doesn't mean the market cares about the economy. So for
Yep.
now, I think there's a lid on how high this rally can go. I think we will see a pullback. How far does it go? That's anybody's guess. But for right now, I see momentum has been positive since like the end of June, and it's probably time for some type of material breather or pullback in the broadest index here, the S&P 500.
Yep, I agree on that one. We're just into a very obvious resistance level with the 200 day, and doesn't mean it has to turn around, but somewhere in this range, if there were to be a sell-off, it's a likely spot where it could happen. So
And we'll get
no,
to a slide here at the end that I think is probably one of the biggest reasons for the rally that we've seen, but I don't want to spoil the surprise. So stay tuned till we get to like, let's see, maybe it's slide like 14. So better move on if we want to get to slide 14.
absolutely. So here's just highlighting again. So this is the SPX chart, but we had these relative ranges in here, and right now it looks like we may have broken out, but I'd like to see it hold a little more before I declare it a breakout. Sometimes you'll just get these little kind of fake outs where it pops out momentarily, high volume comes in, and then it goes back the other way. So we'll see.
Yeah, I mean, I think the main reason that we put this slide in here is just to show you how often we're wrong. Like I think Kyle and I both thought there would be some more resistance in that current red box.
Hmm.
The one where it says breakout or fake out. We probably thought it would drop from there, and it didn't. It just kind of has kept going higher since then, and of course ran into the very next level that we called out, which is the 200-day moving average. So just owning our calls. It's worth showing you guys like this isn't this isn't exact science. It's part art, part science, and you gotta know when you're wrong, and you gotta learn from those mistakes and respect the fact that despite every single technical indicator that anybody could look at, kind of look like the market should stop rallying. Inside of that most recent red box and kind of at least consolidate or drop from there, and it didn't. So the market does not have to do anything. It often does what hurts people the most. So we're not the only technical analysts looking at those levels and watching it happen. So no surprise. I mean, we're wrong fairly often. It's just a matter of how much do you lose when you're wrong and how much do you make when you're right. And
Hmm.
so we'll lose a little bit because we'll admit we're wrong and respond accordingly. That's the major thing to understand there. So I was definitely wrong on this. I thought it would shape up, like it did back in April, and we'd see the market already dropping at least a few percent from where we were last week. But that hasn't happened. Market has just kind of continued to climb, and we'll see if it just rips through the 200-day moving average from here. Never know. I don't think it will, but if it does, we'll be ready to take action.
Yep. So the next one here, oil. This one, I don't know enough about the fundamentals of oil to figure out, what's the value that it should be at. But right now, it's holding under the 200-day right here, trying to base a little bit, but not always set or, comforting when it's under a 200-day. I don't care what asset it is, that it'll continue.
Yep. And
Any thoughts
making
on that?
making lower lows, lower highs, lower lows, lower highs, lower lows. So it is trending down. It is below the 200. It got rejected by the 200. So you can see, I don't know, Kyle, if you want to get your little red dot deal so we can see your mouse a little bit better. But I mean, while you're doing that, I think I could describe for people that, we dropped below the 200-day, we rallied back up into the 200-day and then failed there and dropped. So that is, That is the 200-day moving average acting as resistance, which is what I expect it to do for the SPY, the S&P 500 as well. And so, can it rally from here? Sure. Of course it can. But it's got work to do. It's got, the declining 50-day coming down towards the 200-day. So there's a lot to be bearish about here. But again, if oil holds I don't know what the real price is, but the oil producers, which is what we're focused on, or what I'm most focused on, what I like to trade, um, and even invest in our elevate strategies, is the oil producers. And as long as oil stays above 60, 70, certainly 80, 90, 100 a barrel, those guys are going to keep making money, even though the price of oil is falling. So, um, I'm surprised to see it under 90 bucks so quickly. We'll see how long it stays under 90 bucks. But I mean, again, these guys, it doesn't cost them $90 a barrel to pull it out of the ground. So if they're selling it for 90, and they're paying something less than 90, what's it cost most oil producers to get a barrel of oil out of the ground? I don't know, probably 40 or 50 bucks.
I
That's
thought I
that's
heard
my guess.
once it's like $40 to get it out in the
And
US.
that's probably changed. I mean, labor is going to be more expensive. Yeah, gas to run, whatever heavy machinery they've got to make the well, and um, paying Halliburton and Schlumberger to do the oil services of the actual drilling. Like, I'm sure all those costs have gone up a little bit too. So I'm not sure exactly what it is. I haven't dove too deeply on that recently. But I know it's less than 90. So they're
Yeah.
making money, and in my personal account, I'm long a couple of oil stocks. We can't really pull them up because we didn't have slides for those, but Occidental I'm long. It's one of the best performers of the year so far. So OXY is that symbol if y'all want to go take a look at it. And then CNQ, the Canadian natural resources as well, has been a pretty good one. And it pulled back to its 200-day moving average and is trying to break out above it now. So there's always some opportunities to take a look at out there, in each of these various sectors. So
Yep. And I would say too, I was just gonna point out on oil, you could say we're getting a little bit of a double bottom here. So down
yeah,
here, kind of this 88 level, right here and right there hitting again. So maybe it's a turnaround, but still a little early to call.
yeah.
Um, and here's one of, I think, Shane, I'm the one who's famous for calling gold the wrong way every time. So maybe we'll just start a reverse indicator on me.
There you go.
But we had this downtrend resistance line. We broke out above it. And this is kind of that area where you could say, we're backfilling or retesting the breakout and going higher. But as erratic as this is and unpredictable when it comes to, you know, getting these breakouts, I'm doing hands off, but as part of your portfolio to diversify a little bit, yeah, it's a good ad like we've said in the past.
Yeah, we trimmed our position, for people who were overweight, because of buying at the bottoms, buying at the lows there. We trimmed it, I guess a week or so ago, and maybe twice, during that topping process around 1800. And now you've got the MACD, the momentum indicator at the bottom, flipping red today. Trading back below the 50-day moving average. So nothing looks very bullish about that in the short term. So taking some profits off over the past couple of weeks, but maintaining the long-term long position as a chaos hedge. I think that makes some sense. So,
Yep.
yep, gold looks like downtrend for now, and I'm looking actually to buy some royalty stocks for my wife's long-term Roth IRA account that we can't put any more money into, unfortunately. So yeah, we're gonna maybe buy some Franco Nevada or some wheat and precious metals. I don't know. We've never talked about it on this call. But I was looking with our associate Juan the other day, at how much, how many employees per, like, market cap per employee and revenue per employee on these royalty companies compared to, like, Microsoft and Apple. And it's just funny. Like, if you go divide the market cap, I can't find this chart right now. I wonder if it's if you divide the market cap of Franco Nevada by the number of employees they have, for example, and then do the same thing for Apple, you'll find some pretty crazy stats. Because I think Franco Nevada has, like, I don't know. I think they have 35 employees, right? And Franco-Nevada is a company with a market cap of $24.87 billion dollars. So call it $25 billion divided by 35 employees means each employee is worth $714 million. You know, and at say Apple, Apple is a $2.796 trillion company and it has 154,000 employees. So I don't wonder if I can even do that math on my calculator. Let me see if I can do trillions.
Trillions are
Two
hard to fit in your
seven nine
calculator.
six 000000000. I think that's right. Divided by 154,000. Yeah, so each Apple employee is worth about $18 million. So $18 million per employee at Apple and $714 million per employee at Franco-Nevada. Pretty crazy. It's
Yeah.
about royalty companies are pretty much the most efficient business model on the planet Earth. Maybe only second to like property and casualty insurance, but I mean, you know, Franco-Nevada runs its company with like an attorney and an accountant and a geologist. They don't have to do any of the mining. They don't have to own backhoes. They don't have to dig any holes. They don't have to pay for, you know, big insurance for workers' compensation or people getting injured. I mean, it's a super efficient business model. And so if you want to take advantage of, you know, being invested in gold, royalty companies are probably the best way to do it. And the last thing I'll say about that is like I was reading some research produced by one of our providers. Royalty stocks, let's see, they're basically up. I don't know if it was a 20-year period. Yeah, I think it's a 10-year period. It goes back to like 2008. But these royalty stocks are 1,400% over that term. Um, gold, oh, I can't find it right now. Gold was up like, you know, 20% or something like that, and the S&P 500 was up like 200%. So these royalty companies have outperformed over the long term by a lot.
Hmm.
So something interesting to take a look at.
Yeah, that's some good analysis on that one. So, now the next one, speaking of chaos hedge, is Bitcoin, the solution to inflation and everything as they proclaim. I'm still looking at this. I think you and I had different views. I'm still bearish as heck on this one. This just looks like a bear flag to me. Looks like we're going to break and go lower, but I know you'd been adding. Have your views changed at all?
I haven't added any recently. I still have I think I still have just half of my original position because I stopped out on that last. I stopped out a half on that last drop below the 50-day moving average, but I kept the other half.
Okay.
Um, and so I'm just waiting on that, using the 50-day moving average as my stop for the rest of it, along with kind of that purple upsloping line there. So as long as that holds, I think we're okay. But it does look like it wants to roll over and go lower here. I agree with your call on the bear flag, which is why in my trading account I shorted MSTR today, which is a company you mentioned a few weeks ago, fired their Michael Saylor, CEO guy, for levering up so much on Bitcoin. So that stock is basically, you know, shorting MSTR is a way that you can basically short Bitcoin. When Bitcoin drops, MSTR is going to drop, and basically, you know, the MSTR chart looks a lot like that right there. So yeah, I'm hedged on my Bitcoin exposure with a little short in MSTR as of this morning. So we'll see if that holds up. But yep, I can see some more downside for Bitcoin, but hopefully the bottoming process has started, and hopefully we don't go down and visit the 13,800 level,
Yeah.
which I was initially looking for. I mean, as long as the recent lows hold, I think the bottoming process has begun for Bitcoin. So long term, I still like it, but in the short run, sure looks like there could be some downside ahead.
Yep. So now the next one, fundamentals on the overall market. This has been one we don't have to go too in depth, but Treasury curve continues to invert. It's just,
Oh yeah,
I mean,
we forgot to take the moving averages off of this one. Sorry about that,
oh,
y'all. You can disregard those red and blue lines because they don't really mean anything on this chart. But yeah, this is another sign of the health of the economy. I mean, you know, 40 basis point negative spread on the 10-year yield versus the 2-year yield, which means if you're looking to get interest for 10 years from the government, you should just buy the 2-year bond. So the 2-year bond pays a higher rate of interest than the 10-year bond, which makes absolutely no sense. It just means that the market sees a risk of the United States defaulting over the next 2 years as a higher probability than them defaulting over the next 10 years, which is backwards and silly, but that's what we see. And that just means the short term is not very bright. The outlook is not very bright for the U.S. economy in the short run. So, um, again, it's unpatriotic to not believe in the United States in the long run. I think everybody's bullish in the long run, but in the short term, things get pretty ugly, and that's what the bond market is trying to tell you.
Right. And now this one we've talked about a number of times, but just showing during a bear market, we've seen these strong rallies. This was the great financial crisis where up 14%, 9, 20, and 26, and those still were not the bottom. So just to
Yeah, I'm
keep
gonna
that in
I'm gonna
mind.
leave this I'm gonna leave this chart in here until we get out of the bear market we're in, because people need to be reminded that people have recency bias. We have very short-term memories. We think that what's happened recently will continue to happen in the future, whether good or bad. And so, this just goes to show you bear markets can go on for a lot longer than anyone expects. And a rally of 17% into the declining 200-day moving average is nothing to get all crazy. Oh, I missed it, I should have bought at the bottom. Now you hold, so if you're in cash and you didn't buy at the bottom at the end of June and you haven't put any money back to work yet, um start. Yeah, the market could get rejected at the 200-day and fall from here, but it also might not. Nobody knows. Anybody who tells you that they know is smoking dope, and you should not listen to them. Like,
Yeah.
I don't know, Kyle doesn't know, nobody knows. And so the point isn't to be all in cash or all in stocks or pick the bottom or pick the top. The point is to do what's reasonable and to acknowledge the fact that you're probably going to be wrong sometimes. So should you go put all of your money back to work now if you're in cash? No. But should you put some of it back to work in case you're wrong and the market just rallies higher from here above the 200-day moving average and to a new all-time high and the bear market ends? Trust me, if you don't put some money, if that happens and you don't put some money back to work right now, you are going to be 10 times as upset as you are right now thinking you missed the bottom. Like, you haven't missed anything.
Hmm.
But you can't just be paralyzed. There's always reasons to be bearish. There's always reasons to be bullish, and you're always going to be wrong. Nobody's ever right 100% of the time, especially in trading. And so the idea is you got to lose a little bit when you're wrong and make a lot when you're right. So if you start putting money to work here, pick good stocks, use a trailing stop or a hard stop, whatever, but determine your risk ahead of time and determine, hey, if it goes down from here by this amount, I was wrong and I'm getting out. And pick a few stocks in a few different sectors that make sense, and that's how you get back in.
Yep.
But the idea, like, nobody's going to come and ring a bell and say, oh, the bear market's over, it's time to put all your money back to work. Like,
And,
that's not going to happen.
and I think, Shane, a point I think is important to highlight is that about the time that the market or headlines and market sentiment tells you that the bear market doesn't exist is probably when it's going to come right back screaming back to full life, and you'll see these big sell-offs because the
Yep.
market, we've talked about this, the market loves to upset the most people it can. And how do
Yep.
you do that? You get up here where everybody gets really bullish and excited, and then it goes the other way.
Yeah. Oh,
So
hey man, in the past, let's see, the past like hour since we've been working on this call and starting this call, the market's dropped 0.5% from the highs of the day, for the second time today. So, erasing the market goes down a lot faster than it goes up. So we'll see what happens, but market can erase that whole 17% gain that we've seen in the past, 6, 7 weeks. Can erase that whole thing in a week or less. Just get the wrong data, the wrong Fed message, hike too high, some unemployment numbers that don't go the way we want them to. GDP is estimates for Q3 are already coming down. There's just a whole bunch of bad things that can happen, and when markets go down, they go down in a hurry. So
yep.
they grind higher and go down very quickly. So we'll see what happens. we've got stops on all our positions, so we know how much we're willing to risk. We're comfortable with that risk. And if those stops are breached, we'll get out. We'll hold more cash and we'll look for opportunities to get back in. So it's
Yep,
that's why I love this gig, man. It never gets old, and it's never like a repeat of the past.
yep. And Shane, I think you went and picked this stock up pretty quick, but the idea was right now the overall market, the S&P 500, is raced higher. And you think, oh, did you miss everything? And I think you found this one. It's just there's a number of others like this, but
Well,
quite the
yeah, let's.
downtrend and little
I
bounce
mean,
maybe.
to be crystal clear, like you asked me a question. I mean, that's why this is in here. You ask because other people are asking you when you're out there talking to clients, talking to prospects, people who are sitting on cash and they're crazy bearish and they're skeptical on the market right now and they don't want to put any of their cash back to work yet because now they've missed it, you know. So you said, hey, are there any stocks out there that are down that, people could go look at and maybe have a chance to put some money back to work? So this was just kind of one that we've been watching for a long time. We don't own it. We have no position in the stock right now, professionally or personally, but I love this stock. This is Logitech. If you look down at your keyboard right now, if you're watching this at a PC, you probably have a Logitech keyboard or a Logitech mouse or some Logitech headphones. I mean, I love their keyboards and their mouse packages. I have a Logitech gaming mouse right here. It's pretty cool. It's got all types of neon colors on it. And I've got a Logitech keyboard, which is, oh, can you see it? I don't know. It's
A little bit.
gosh, this thing's beat up, man. I've had it for a long time. It works well. I like the way the keys feel and sound, and I probably am overdue for a new one actually. But we buy Logitech keyboards for our employees when they start. Logitech mouses generally come with that. Uh, and they're a good company. They their stock went up a lot during COVID when everybody was working from home and trying to build out their home office. Everybody needed a new set of keyboard and mouse components and maybe some headphones to do these kind of Zoom calls. This is actually not a Logitech headphones. We use the HyperX headphones, which are pretty awesome. Um, but anyway, I mean, COVID set their sales skyrocketing. If you went to their website and tried to buy a keyboard and a mouse, like they didn't have any. Like they were sold out. You could get some on Amazon still. You could get some used stuff. I mean, you could get some from some other vendors, but you couldn't buy any mouse or keyboard board components directly from Logitech for the longest time. And their stock went all the way up to $140.17. So
Yep.
maybe it'll never get back to that all-time high. Maybe COVID pulled so much sales forward that it'll never actually go back there in any of our lifetimes. I sort of doubt it. I think if you give it enough time, even if it's a decade, I think you could get up there. Now, to put it in perspective, Logitech is only it dropped a lot, dropped from 140 all the way down to $50. I mean, call it down 75% or something like that. And it's a good company, it's not expensive based on fundamentals. Kyle, if you want to hover your mouse over the fundamentals there, the EV to EBITDA. So the enterprise value is only 10.81. Anything under 12 is essentially cheap. So 10.81 is what you see there. Kyle's not hovering his mouse over
Yep.
that, but that's okay.
Right there.
Well, yeah, just leave it there. There you go. So that is the best fundamental indicator that I use to compare companies across industries, because enterprise value takes into account all of the debt on the balance sheet and any cash on the balance sheet along with the market cap, and then uses earnings before interest and taxes and depreciation and amortization, which is different, if you're running a railroad versus running a software company, for example. So it's the best metric I can think of to compare companies in different sectors and different industries, and anything under 12 is pretty cheap. It catches my attention and it's something I'm willing to look at. The next metric is price to sales. So while a whole bunch of the market we looked at last week, is still trading at 20 times. Is that right? No, it wasn't. Couldn't have been 20 times price to sales. I don't know. We looked at it last week, but the price to sales measure for the S&P 500 is still at the dot-com bubble extreme and 1929 extremes. So the market is extremely expensive based on price to sales. You can buy Logitech, which is again a good company with real products and real revenue, and you can buy it for less than 2 times its sales. So that the number 2 for price to sales is something that I look at pretty carefully. So anything under 2 will catch my attention. Price to earnings only 17, so that is trailing price to earnings ratio, and it's below the S&P 500's trailing PE. So it's cheaper than the market based on price to earnings. And revenue has grown by 70% over the past 3 years. So that goes back to pre-COVID levels to the most recent trailing 12 months, which is obviously post-COVID. Except for people like Kyle who have COVID again. But revenue is growing. So you're getting a growth stock that is still down a whole bunch off of its highs. It's also up off of its lows. So it's cheap. It's probably hated by the market, but it's in the beginning of an uptrend. So cheap, hated, and in an uptrend is what you want. You don't want cheap and loved. Those two things usually don't come together anyways. Usually once it's loved, it gets very expensive, and it's at the end of an uptrend. So Logitech has 180% or so upside from here to get back to its all-time high. Even if it took 10 years, that's 18% a year for the next decade. So if you want to buy Logitech here at $56 and put a stop in at 50, it's near its lows, or whatever the low is. If I could hover over that, I'd tell you. So if you buy it here and you're risking $6 a share to make $100 a share, that's a pretty good risk reward.
Mm-hmm.
So if you're one of those people who is skeptical on the market and thinks we're going to go to new lows and all that kind of stuff, and you're sitting on all your cash and you haven't put any cash back to work yet, this is exactly the kind of company that you could buy.
Yeah. And Shane, I think the big thing here on this is we suck at picking stocks. We've said it. We have win rates of
Oh, I don't
60%
know
on a
about
very
that.
good
I
day.
think I'm pretty good at picking stocks. I don't think I suck at it at all. I'm not right 100% of the time, and nobody is, but I think my win rate's higher than a lot of people if they're being honest.
Right. But good to be modest in it. And the important thing is it's risk reward. If you can bet $1 to make $10, you could throw darts at a dartboard and it might work out for you in the end. But importantly, when you have risk reward setups like that, if you're wrong, you lose a little bit. But if you're right, you make a really nice return.
Yeah. I mean, on this one, the risk reward is like 100 to 1. So you could lose
Yeah.
100 times and be right once, and you'll be even on the day. I mean, being even is not why we're here. We're here to make money. So you got to do a little bit better than that. But yeah, your point is well taken, that you got to lose a little bit when you're wrong and make a lot when you're right. And then you don't have to have a 50% win rate. You certainly don't have to have a 100% win rate.
Mm-hmm.
So let's see, there was one other thing I was going to mention on that, but it has sort of left me. So, oh, this is what it was. But if let's say you had $100,000 in your investment portfolio and it's all in cash because you're bearish and you don't believe in this rally, and your normal position size is 10%. You're going to have 10 different stocks at $10,000, which is fine. I mean, no reason to have more than 20. So whatever your deal is, if you were going to plug Logitech in to your portfolio and your overall position size is $10,000, that's your target position size, don't buy all 10,000 here. That would be crazy. The momentum is just about to roll over. It looks a lot like the Bitcoin chart, where it kind of looks like a bear flag. Looks like this thing could easily roll over and go to new lows. So even though I like Logitech, I like the fundamentals, I like the product, I use the product, the chart look like, you can make an argument for a lot of upside here. It does not mean that it can't go down or won't go down. So if you buy it at 56 and put your stop at 50, hypothetically, put buy 3,000 out of the $10,000 target. And if it holds this purple line and it holds the 50-day moving average, add another 3,000. Basically, as long as it holds the $50 stop, you can add to the position and get it and work your way up to that $10,000 target position size. You do not have to buy it all at once. Certainly you can. You're not risking that much, right? You're risking 10% to make 180%. That's a great I mean, you'll be fine, like we just said. But you also don't have to put all your money in at once. You want to add your winners and cut your losers quickly. So that's another aspect of if I were going to plug this into the Elevate strategies, I wouldn't buy the whole position all at once. I
Hmm.
would nibble on it and see how it reacts, and then nibble some more and see how it reacts. And as long as it holds above the stop, I would work my way into the full target position size.
Yep. So now this last, I don't know if you just touch on this, but Michael Burry, everybody I'm sure remembers him from the movie The Big Short. Um,
I
this
don't
is
know about
just,
everybody. Guys like you and me probably know who he is, but most people probably don't. This is a guy who made like, I don't know, $400 billion or something, shorting the housing crisis when everybody told him he was crazy and that mortgage rates never went down. If you haven't seen the movie The Big Short, you should go check it out. If you have seen the movie The Big Short, you should go watch it again, especially like the last 5 minutes where it talks about, how you know the market did what it did, and then we blame teachers and poor people for what happened, when really it was mostly the bank's fault. So Michael Burry he's the man. He's not right on every call that he's ever made, just like anybody else. So who knows whether he'll be right here, but he did nail the housing crisis, and he stuck to it even when people were calling him crazy and he was losing money on his trade for I don't know, the first, I think probably year or so, he was losing a lot of money on the trade. And then one day it all paid off. Um, so we pay attention when he has things to say. And I mean, if you've read the screen while I've been talking here, we are basically, at the average bear market rally with the NASDAQ up 23%. So the NASDAQ has rallied more than 23% lots of times, and it just turned out to be a bear market rally, and we dropped to a new low after that. So we'll see what happens, but there's definitely evidence out there to suggest that we're not totally out of the woods yet.
yep. And here's something talking about getting out of the woods, GDP. It's a pretty good indicator of what's going on. Of course, doesn't indicate a recession, as we've now been informed, but
It does, if Biden's not the president, it indicates a recession. But when they're lobbying hard for people not to declare it a recession, then no recession will be declared. So
mhm.
shocker. Yeah, I mean, this isn't, this slide wasn't meant to just show GDP though. It was meant specifically to look at personal consumption. And at the bottom right side of the screen, look at the bold, particularly the bold.
Yep.
That's the big takeaway. This rising inflation means Americans are spending more for a lot less, and to top it off, they're using credit cards to do it. So if you unpack, what it says here, personal consumption has fallen 60% over the past 2 quarters, which is the left-hand side of the chart. So it's now down to 70% from 1.76% in Q4 2021. Man, I wish I could control this mouse. Um, so Kyle, Q4 2021 was
Yep.
1.76. Oh, your red dot got stuck again.
There we
There we
go.
go. Yeah. So it dropped from there to 70 basis points over the past 2 quarters. So that is the 60% drop. Um, Even worse is the slowdown in demand compared with the second quarter of 2021's 7.9% surge. So back there, 7.9% growth in consumption off of the COVID lows. But on the right-hand side of the chart, you'll see over the same period, the nominal personal consumption grew by 4.2%. So it's not a good situation when you're spending more money but getting fewer items, getting
And
less in the forms of goods and services.
Shane, for those who don't know, can you explain difference between nominal versus real?
Probably not in the time that we have left on this call. But yeah, I mean, one's just percentage based and one's based on dollars. So, I mean, looking at the dollar amount change, right? In terms of, I can't say real when I use nominal. So, they're just very different. One's adjusted for inflation, and the other is not. So, just looking at the nominal change just means the dollar amount change, and the other side, the quarter over quarter percent growth, is looking at simple percentage based changes. So nominal versus percent base is the quickest way I can explain that.
Yep. And that's, I was going to say on this one is kind of think of it a basket of groceries. Over here, it's tracking the quantity of groceries is going up or down, whereas over here, it's tracking it based on dollars. So you might buy that same basket of groceries this month versus last month, but now it just costs more on a dollar basis or a nominal basis.
Next time you have a
Right.
better answer than me, just give it.
You gave me time to think of a good one while you were
There you go. All
talking.
right, that's a good way to explain it. Very concise. I like it.
So
Uh,
here's another one. So power plants in Europe. This is interesting because natural gas has just been headed to the moon and winter's not even here. And here we go. We're going to go green energy policy, and maybe you can give us some details on what's going on there.
yeah, look, Germany is not the sunniest place in the world. I don't know if you know that, but there's not a lot of sun over there. There's not always wind either. And these guys have been shutting down nuclear power plants um, in favor of renewable energy sources like wind and solar, just in the name of being green. And they've been financing the difference with cheap gas from Russia, but now they're shutting that down as well because they don't want to support Russia, and it's forcing them to keep their nuclear reactors on for longer than they wanted to. I think anybody who wants, to reduce emissions and produce more energy using fewer fossil fuels needs to be advocating for nuclear. I mean, nuclear is the only way um, to reliably reduce those emissions. It's it's the most efficient energy that there is on the planet Earth. And I don't think that's likely to change ever. I don't care how many solar panels or how many windmills are built. Those things require petroleum to build. They contain petroleum. The blades of wind turbines are impossible to recycle, and when they break, they just get buried in the ground to rot and rust. Um, there's a whole bunch of things about solar and wind that are not as green as the media would have you believe. And the most energy you can get out of the smallest amount of resource is always going to be through a nuclear reactor. So, one idea, which I think is a fantastic idea, is to build some more nuclear power plants all around the world in places that are sunny and windy, and surround them with 10 or 20-mile radius of solar panels and windmills, because nobody wants to look at solar panels and windmills out their window, and nobody wants to live within 10 or 20 miles of a nuclear reactor either. So those things can feed off of each other, and the nuclear power can work when it's not sunny and not windy and nighttime. That happens every day, believe it or not, all around the whole world. So it's not, it's not up to one source to meet our energy needs. The idea is to have a diversified um, way to produce energy for the world, and nuclear is definitely part of that answer. The reason I put this in here though is because Germany is just like they're just like the poster child for the at all cost mentality. California's been doing this too. I mean, they could build nuclear reactors in California and not have rolling blackouts, but instead, they're anti-nuclear and anti-fossil fuel and pro blackouts apparently. So ultimately, though, the reason I put this slide in here is because we can look at some opportunities to invest in uranium, which is how you take advantage of things like this. Each one of these nuclear power plants was planning to be shut down and wasn't planning to buy any more uranium for their reactors. Now they'll have to. And one of the biggest or the biggest uranium miner in the world is Cameco. Symbol is CCJ. That one is actually consolidating just above its 200-day moving average last time I looked, and might be a good long-term buy for people who are looking to participate in that. And then there's also some uranium ETFs. URA is one, and URNM is another. So uranium is, I think, here to stay, and you can take a look at those investments if you're interested.
Nice. Now we'll wrap it up here. You just got a few more we'll touch on quick, but you know, I think you brought this up because we were talking, well, what other opportunities still exist? Well, small caps still they sell a long ways to go back to the tops or the
Yeah,
highs.
and Yeah, and just quickly at the bottom, you'll see here after the extreme is just what's happened kind of over the past 2 months. So even though small caps have rallied by a certain amount over a certain amount of days, if you look back through history, how many times that has happened, what has happened in the subsequent 3 month, 6 month, and 1 year period. So during all periods, the small cap Russell 2000 index is up, 2.1% in 3 month periods. And it's up 4.3% 6 month periods and 8.8% a year. If you only look at the 3 months following an extreme rally, like the one we've seen over the past 2 months, it's up 7.1% over the next 3 months compared to 2.1% for all periods. And the 6 month number is 17.2% versus 4.3, and the 1 year number is 34%. So if history is any indicator, this is just the beginning of a rally for small cap stocks. So 1 year from now, on average, it might be up another 34% from here, even though we're up already 23% or 2 months. So sometimes the trend is what you want to stick with, and if this is the beginning of a new uptrend, you would not be crazy to buy it here.
Yep. Now this chart, tell me kind of what you're looking at here. I wasn't as familiar with this one.
So this is just the amount of short covering. And so ultimately, all it's trying to say, and I'll just keep it pretty simple, is that I think a large part of the reason that the market has rallied so much over the past like 6 weeks, really mostly over the past 3 weeks, is because people who were short the market were forced to buy the stock back that they had sold short. So people who were betting that the market would go down had to either one of two things: either admit they were wrong and buy those stocks back, or they had made enough money and they were convinced that the stocks are done going down, so they bought the stock back to book their gains. And so if you look at the little red circle in the bottom right of this black chart and then look back to April of 2020, it's kind of the same, right? That was the spot where the short covering had stopped back during COVID. So the market did rally, from there heavily, and of course the short covering shot way higher from there. So we'll see what happens from here on out. But I think a lot of the buying power in the market has just been kind of wiped out. Most people are probably back to flat now, and the market will actually have to rise without people covering their short bets from here. I think that's probably unlikely. There are a lot of differences between now and April of 2020. Namely, the Federal Reserve Bank was printing money and stimulating the economy and paying to keep it closed. And now they are doing the opposite. They're tightening, taking money out of the economy. And so the market will have to rise on its own without any support or stimulation from the Fed, at least for now. And now that the short sellers are mostly out of the market and they're shorts, they have the ability to re-enter those shorts, and they certainly aren't forced to be buying back into stock. So I think a big part of the reason for the rally that we've seen over the past 3 weeks has been people buying their shorts back and getting flat the market. And now that that's done, I'm not sure how many people are putting new money to work long at these levels. I think a lot of people are probably waiting for another dip before they do that. So I just think, the short covering has been huge over the past 3 weeks, and over the past couple of days, it has stopped.
Yep. Same. And then this one, I think, just looking at housing affordability, I think we've talked about this before, but just not in a great spot. And that's kind of where you're seeing real estate pullback. Not much more to add there. Do you have anything?
Just don't be long the home builders. If homes are unaffordable or not nearly as affordable as they used to be, then fewer people will be buying them, which means the home builders won't make quite as much money. So the next chart just shows you that the home builders have rallied 30% off the lows. They're running into the 200-day moving average as well. Likely due for a pullback, especially based on the economics of the prior chart that shows prices are not very affordable compared to the recent history. So yep, that's about it.
Nice. And I think that wraps it up. So, looks like we're getting just a little bit of a rally to finish up the call, but I just kind of a sideways day, so we'll see. But thanks as always. It's been a pleasure, and I guess we'll see everybody next week.
All right, man. Hope you feel better.
Have a good day.
All right, see ya.